Hey everyone, so today we're going to go over the DFW underwriting file. Not sure if you have taken a peek at this, but it's something that we look at very closely to determine whether or not we think that the deal has been underwritten conservatively and just kind of understand how things are going to work in general. So this is the dashboard page that just kind of gives an overview of um, the deal. So this is an equity raise of about 37 million. As you know, the annualized return is 18%, equity multiple of 1.9 and IRR 15.2. And we have charted out the likely scenario, the worst case scenario, and the best case scenario. And this would be the likely scenario, all limited members that you would be looking at. So the likely scenario is right here. And then the worst case scenario, given what we think that, in all likelihood, the worst case scenario would look like a 10.8 IRR, a annualized cash on cash return of 12%, et cetera. And then in the best case scenario, we're looking at potentially a 21 IRR and an annualized cash on cash return of 26%. And annualized just means when you look at the life of the deal, which is going to be approximately 5 years, although it could be more, could be less. You look at the life of the deal, the cash flows you get during the course of the deal, and then you get your capital return as well as a big chunk at the end because we've increased the value of the property. And so when you combine all of the returns and divide them over the number of years, that's what an annualized return is. So let's go to inputs and just check out what's in that tab. So this is everything in blue. If you're going through this yourself is an input, and everything in black is either automatically calculated or just like already in the sheet. So we have assumed an LTV of 70%, purchase price of 88.5 million, the perm rate of 3.25%. And for now, I'm going to go ahead and skip over to the unit mix because I think that this is a natural place to start. So this is a pretty big portfolio. It's 18 facilities. And so this page is pretty extensive. So let's just go over some of the columns. So each of these little sections, like this first section, is one property, the Terrell property. And we'll just go down these rows. So this, if it says CC, that means climate controlled. So in storage, you want to keep track of whether a unit is climate controlled or not, because that will yield a different result in terms of pricing. And so here's the size of each unit. As you can see, these units are 5 by 5. These units are 10 by 10 feet. Then that's the square foot per unit. It's calculated automatically. 10 by 10 is 100. And then over here, we've got the number of units available. So then you multiply the number of units available by 100 and you get 1,800 square feet of this particular unit type, which is a 10 by 10 unit that's not climate controlled. Currently, there are 14 vacant out of 18, which is kind of a lot. And what's the rent? $89 is the current rent, and just like overall. So here's the current situation in this current tab, and then here's the market situation. So this is what we're going to be aiming to get to. And so this is what's currently being collected monthly. And then from that, the physical occupancy is calculated as well as the economic occupancy. And then we go over here and we look at, okay, what are the market rate rents? And we look at those based on looking at comps in the area, what other facilities are getting. And so the monthly gross potential for rent on this type of unit is $236 on a monthly basis, which is this unit type times the number of units. So the number of units is in F5 right here, 4 units times the market price, and then you get the gross monthly potential rent. So this is the current economic occupancy based on the market rate rents, and we're planning on increasing that quite a bit by 34.1%. So as you can see, we take a very granular look at every single property. So we're looking at every single property, every single unit type. We're making assumptions based on market research and figuring out what we think is a reasonable market rate. And that's how we get to our overall anticipated gross potential rent numbers. Now, it should be noted that we keep storage separate from the RV spaces, which is separate from other. So like here's Terrell property again, and these are the RV spaces. And we do the same type of analysis here. And there's lots of nuance in here. We're not going to go through it all because it would just take a very long time, but this is just to give you a general overview. So now, we know what we think the gross monthly potential rent is. Let's go back and look at something which I think is very important, which is some of our assumptions that we make. So back to the inputs page. So here's some important assumptions that we're making. We are assuming a maximum economic performance of 90.25%. That's very important. That means that we're basically assuming an economic vacancy of about 10%. And then over here, we're assuming that once we hit the market rent, so basically we have a prediction of what we have a conclusion of what the market rents should be. So in that first example, it's going to go from 44 to 59. Once we hit that 59, then we're increasing rents at a rate of 2% per year. So more on that. So we're not projecting any rental increases from month 3. And we're giving ourselves a full 2 years to get to market rate rents. And from then on, after 2 years, then we'll increase rents at 2%. Now, this is all very conservative. Why is it conservative? Number one, we are not anticipating taking 2 years to be able to increase rates to market rent. In actuality, we presume it'll take about 6 months, maybe, a year at the most, to increase rents to market rate. So we're giving ourselves a whole extra year to get to market rate. And then at that point, we're only increasing rents 2% every year, which is very, very conservative. So that's one of the reasons why I love working with this group, is because they have I can't tell you how many, models I'll look at where the rent growth is assumed at 4% or 5. And it's not that that's not, a good guess. Like, it may be accurate, but it's just not necessarily conservative. I mean, there are units like in multifamily where rents are increasing 7-10% every year, 12% even. And so it seems like a 5% rent increase is not unreasonable. However, you just never know when there's going to be a shift in economy. And so having a 2% rental increase after reaching market is very conservative. And it makes one of the things that makes me feel extremely comfortable with this deal. Okay, so here is information about how we calculate property taxes, and just so you kind of know where that is. And now I'm going to go over to the monthly P&L. So this is where we are looking at our projections on a monthly basis. So we're going to close October 21 and give ourselves 3 months. And then as you can see at that point, so gross potential rental income is not being increased for the first 3 months. And then we're incrementally increasing it until we get to market rate, which will be in October of 2023. So here we go, we reach market rate. And at this point, we're increasing the rents by 2% a year. So as you can see right here, 90.25 economic occupancy rate. So this is where we hold it. We're not planning on getting any more rental income besides this 90.25% economic occupancy rate. That's our built-in vacancy factor. And it's another reason why I feel very comfortable with this model, because we're not assuming that we're going to be at 95% economic occupancy, et cetera. Also want to draw your attention down to the expenses. So we always look at our expense ratio when we are looking at these deals. And I mean, it's important to go through every line item, but usually the first thing I will look at is the overall expense ratio. So we're currently at 36%, and we're planning on slowly bringing it down. But this is a very reasonable rate of operating expenses, 32%, 31%. That's all within reason as far as a total expense ratio. So by that, I mean total expenses divided by total income. So now I'm going to move to the annual tab, and we're going to, so basically that monthly tab pulls over into the annual tab. So then you can get like an overall look at the total properties. So they've split it out into storage rents, RV rents, and other rents. And here we've got everything just on an annual basis. And so here you can see our operating expense ratio doesn't go below like around 32%. And now here's another really important point is cap rate. So cap rate is a really important, it's an extremely important way of looking at these deals. And what you want to look for, you always want to make sure that the deal that you're looking at is assuming that the economy is going to get worse. So when the economy gets worse, cap rates expand. So what is cap rate, first of all? Well, cap rate is calculated by taking the net operating income, so income minus expenses, and dividing that by the value. And so the cap rate moves along with the how hot the asset class is, as well as where the economy is. And when the economy is doing well, cap rates are going to go down, which means that people are willing to pay more for the same income stream when there's less risk. So that the economy is going really well, people are going to feel more confident and they're willing to pay more for the same income stream. When the economy is doing more poorly, then people are willing to pay less for the same income stream. So in this case, we are increasing the cap rate by 0.4% every year. So it's going up from 5.19, which is current cap rate, to 5.35. And an expanding cap rate is just something you always want to look for. You always want to assume that the economy is going to be worse than when you purchase the property. Here's our debt service coverage ratio. This is another really important metric. This, I always like to harp on how debt is one of the reasons why real estate deals go south. Like the biggest concern with the real estate deal isn't that you're not going to hit your projections, it's that you're going to lose a lot of your money. And when I talk to people in my podcast and in life about what it is that has caused these situations, it almost always ties back to the debt structure. And so you want to make sure that your leverage is really conservative. Banks like to look for a debt service coverage ratio of at least 1.25. They consider that safe enough to lend on. As you can see in this example, we're starting at a 2.19, and we go up above 3 even in year 3, and then we have around a 2x DSCR, which is very, very comfortable and gives us plenty of leeway for if all of a sudden something goes really poorly and people stop renting storage units, we have just a ton of room to continue to be able to make our mortgage payments. So this is something that investors generally care about, cash on cash return on an annual basis. So we're looking at, approximately 6%, then 8%, then 12%. Usually goes back down. So we catch up to our 7% preferred return. So we didn't hit it here. And then we go back down. So that's why you kind of see it peaking in year 3. Okay, so what else should we touch on? So here's the exit strategies. So, for our shares, we're looking at here, the cash on cash is just broken out a little bit more, like how did we actually arrive at that cash on cash? So this is the preferred return. You can see it pulls from the monthly P&L section and the terminal value. So this is what we assume we're going to be able to sell it for. So in year 5, we're planning on selling it for basically 50 million more dollars. And how did we arrive at, $50-60 million increase? Well, number one, we're going to be improving the operations at every single portfolio because they're not optimized. They've been run by mom and pops and they have not been running efficiently. Rents are at market rate. They're not fully rented. We're going to bring them online so that and we're also going to upgrade the facilities. And so that's one hand is like improving the existing operations. And then the second part is expansion. So we're expanding by at least 150,000 square feet. And that extra expansion is a huge part of how we create so much value in a short period of time. A lot of times you'll look at multifamily deals and they won't be adding any units because it's much more difficult to add units to multifamily. With storage, with multifamily, you're often relying on just increasing rents through improving the community and improving the interiors, etc. With storage, we can actually build more storage where there is demand. And so we are going to be building in, so this is the expansion. So I'm back on the unit mix. So this is our expansion. We're expanding 147,200 square feet. And we are assuming that this amount will be added to our monthly gross rent potential. Okay, so it's on an annual basis, basically adding $2 million to the net operating income minus expenses. And we may be able to build more, but we're going to just assume 150,000 square feet to be safe. So so we looked at the debt, it's conservative. We looked at the income, 2% rent growth after 2 years is conservative. We looked at the expenses and we looked at the expansion. And so I think that that's a pretty good overview of some of the basics. Of course, you can always drill into the details and look at every single line item, which is something that I definitely make sure to do anytime I'm doing a deal. You want to make sure that you understand exactly how they arrived at every single number and is it reasonable and is it supportable and do you feel comfortable with it? So that is an overview of the underwriting summary. I hope that was helpful and I hope you consider investing in this deal. If you have any questions, please use me as a resource. We're running out of time. So the final funding deadline is going to be October 14th, 2021. And really love to get you in. So give me a call if you have any questions. It's always available on a first come, first serve basis. We're 70% full. And that's all for now. So thanks so much, you guys. I'll talk to you later. Bye.